This deep dive is brought to you by Cert Fuel. They've got a full securities industry essentials course with adaptive study quizzes, smart flashcards, and unlimited practice exams weighted just like the real thing. Check it out at certfuel.com.
Highly recommend it.
Yeah, so, okay, what if I told you that taking your life savings and burying it in the absolute safest, most explicitly government guaranteed investment in the world is mathematically guaranteed to destroy your wealth over the long run?
I mean, it sounds completely backwards, but it's basically a fundamental law of finance. Welcome to the deep dive, everyone.
Right. Today we are pulling from a massive stack of sources. We're talking SIE exam prep manuals, historical market data from the Fed, and a few really fascinating behavioral finance studies.
Yeah, and our mission today is to master the mechanics of investment risks.
And we are not going to just read a glossary of terms, because if your brain is anything like mine, standard textbook lectures are just, a fantastic cure for insomnia.
Yeah, a terrible way to actually retain information.
Exactly. We want to understand the plumbing, the actual mechanics of why money behaves the way it does.
Because when you sit down for the Securities Industry Essentials exam, the test makers, they aren't going to ask for basic definitions.
No, they're going to throw these convoluted, multi-paragraph hypothetical scenarios at you. But if you know the underlying mechanics, you can dodge those tricks in your sleep.
Right. And to do that, we have to start with the bedrock, the universal law that governs literally every transaction in the global economy.
The no free lunch rule.
Exactly. Risk is simply the possibility that an investment's actual return is going to differ from its expected return. That's the technical definition anyway.
Right, but practically speaking.
Practically, risk and return are permanently tethered to each other. They are perfectly positively correlated.
Which means if someone promises you, equity like double-digit growth with the safety of an FDIC-insured savings account,
they are either fundamentally misunderstanding the market or, they're about to be indicted for wire fraud.
Yeah, exactly. There is no such thing as a truly risk-free investment. Safety in one specific area mechanically exposes you to a completely different vulnerability somewhere else.
Yep. Understanding which vulnerabilities attach to which specific financial vehicles is the entire ballgame here.
So to make this stick, I want to introduce you to 3 recurring characters. These are our archetypes, and I want you to visualize them throughout this whole discussion.
Because they represent the exact behavioral profiles the exam's going to test you on.
Right. So first we have cautious Carl. Carl is terrified of losing a single penny of his principal.
He loves safety. He hates volatility.
Oh, yeah. His blood pressure spikes if a stock chart dips even a millimeter.
And then we have his polar opposite, risky Rachel. Rachel is a total financial thrill seeker.
She's out there hunting for double-digit yields, complex options contracts, wild market swings.
She's practically base jumping while trading on margin, right?
Yeah.
She wants maximum return and is perfectly willing to risk total ruin to get it.
Yeah. And finally, we have forgetful Fred. Fred represents pure apathy. He buys a financial product, buries the statement in his backyard, and completely ignores it for 20 years.
He's constantly getting caught off guard by changing macroeconomic tides because he just assumes financial markets are static.
Exactly. So keeping these 3 in mind, let's do a quick thought experiment. Put yourself in cautious Carl's shoes for a second.
Okay.
If Carl puts 100% of his net worth into U.S. Treasury bonds because they're considered, quote unquote, risk-free, is his wealth actually safe?
Take a beat. Think about it.
No.
The answer is no. I mean, he has eliminated credit risk, meaning the U.S. government is not going to default on his payments.
Right.
But by doing so, he has vastly increased his exposure to inflation risk and interest rate risk. The purchasing power of his, quote, safe money is just going to quietly erode.
Yeah, it's wild. So let's start with the nightmare scenario, the risk that keeps most people awake at night. You log into your brokerage account and the money is just gone.
Yeah, this is capital risk, sometimes called principal risk.
Right.
Capital risk is the probability of losing part or all of your original investment, your actual principal.
And the moment you move your money out of a bank and into a security, whether that's a stock, a bond, an ETF, whatever, your principal is no longer guaranteed.
A lot of textbooks use terrible analogies for this, like dropping a sandwich.
Which makes no sense.
Right. But let's look at the actual mechanics of a corporate bankruptcy, because that's what capital risk really is. Think of it like a buffet line. This is called the capital stack.
Oh, that's a much better way to look at it. So if a company goes bankrupt, they liquidate their assets to pay people back?
Yeah, but there is a strict legal hierarchy to who gets to eat at that buffet.
Exactly. First in line are the secured creditors, the lawyers, the IRS, and the bondholders. They take the prime rib.
They take the best food. Then come the preferred stockholders, taking whatever's left,
Yeah.
mashed potatoes.
Yeah. And finally, at the very back of the line, you have the common stockholders.
And as a common equity holder, you have the highest capital risk, because by the time the buffet line reaches you, the trays are usually completely empty.
There's just crumbs. Your stock price goes to absolute zero.
Right, and if you want to dial capital risk up to the absolute maximum, you just look at the options market.
Oh, yeah. Let's say Risky Rachel buys a call option on a tech stock.
An option is a wasting asset. It was a strict expiration date.
Right, so if the stock doesn't move the way she predicted by that specific date, the option expires totally worthless.
She doesn't just lose a percentage. She loses 100% of the premium she paid.
Wait, hold on. Let me play devil's advocate for cautious Carl here.
Okay.
If Carl is terrified of being at the back of that buffet line, he's just going to put his money in a standard bank savings account. All right.
Sure.
How does FDIC insurance actually work mechanically to eliminate that capital risk?
Well, the Federal Deposit Insurance Corporation, or FDIC, is an independent agency of the U.S. government. It protects depositors against the loss of their insured deposits if an FDIC-insured bank or savings association fails.
Okay, but what's the limit?
The mechanical limit you must know for the exam is $250,000 per depositor, per insured bank, for each account ownership category.
Okay, so if Carl has $300,000 in a single individual account at one bank, and that bank collapses,
The FDIC cuts him a check for $250,000.
and that remaining $50,000 is suddenly exposed to massive capital risk.
Precisely. But here is a critical nuance where candidates frequently lose points on the exam.
Okay, this is where the exam tries to get you. Listen up.
Test makers love to present a scenario involving U.S. Treasury bonds and ask if they are free of capital risk.
Oh, this is such a brilliant trap, because the intuitive answer is yes, they're backed by the full faith and credit of the government.
But what's the actual answer?
The actual answer is U.S. Treasuries are only free of capital risk if held to maturity.
Exactly. The government guarantees they will hand you your full principal back on the specific day the bond matures.
But what if Carl buys a 10-year Treasury and 3 years later he panics and wants his cash back?
He can't go to the government and ask for a refund. He has to go to the secondary market and sell that bond to another investor.
And if interest rates have risen over those 3 years, his older bond is way less attractive.
Yeah, the only way he can sell it is by accepting a discount. He might have paid $1,000, but the market will only give him $900.
Wow. So he just experienced a $100 capital loss on a quote-unquote risk-free asset.
Exactly. So capital risk is losing your investment due to market forces or bankruptcy. But let's slide over to its sibling, credit risk.
Right, so if capital risk is being at the back of the buffet line, credit risk is the risk that the restaurant permanently shuts down before you even walk in the door.
That's a great way to put it. Credit risk, or default risk, applies specifically to debt instruments, bonds.
Because when you buy a bond, you are lending money to an entity like a corporation, a municipality, or a sovereign government.
And credit risk is the mathematical probability that the issuer is going to turn into a deadbeat and fail to make their scheduled interest payments, or fail to return your principal.
And the financial system doesn't just, guess who is reliable. We have massive institutional rating agencies whose sole purpose is to evaluate the balance sheets of these issuers.
Right. Moody's, Standard & Poor's, and Fitch. They issue credit ratings that act like a standardized GPA for corporate health.
Yeah, and the dividing line you absolutely must memorize for the exam is the threshold for investment grade.
Super important.
For S&P and Fitch, that line is BBB-. For Moody's, it's BA3.
Anything at that level or higher is considered a relatively safe investment-grade bond.
And anything below that threshold drops into speculative territory, the high-yield bonds.
Or, as the industry colloquially calls them, junk bonds.
Junk bonds, yeah. And this is where the behavioral profiles really matter. Risky Rachel actively hunts for junk bonds.
Why? Because the bond market is incredibly efficient. If a struggling corporation wants to borrow money, no investor is going to lend to them at a normal 4% interest rate when they have a massive chance of defaulting.
Right. The company is forced to offer a juicy 10 or 12% yield just to entice buyers.
And Rachel accepts that massive credit risk specifically to harvest that high yield.
Meanwhile, Cautious Carl wants absolutely zero credit risk. So he'll pass standard corporate bonds, and he buys Government National Mortgage Association bonds.
GNMA, or Ginnie Mae bonds.
Yeah. Why Ginnie Mae?
Because GNMA is the only agency whose securities are backed by the explicit full faith and credit of the United States government. They have effectively zero credit risk.
Okay, wait, let me push back on this.
Go for it.
If GNMA bonds have the explicit backing of the U.S. government and effectively zero default risk, why wouldn't every investor on Earth just put 100% of their fixed income portfolio into Ginnie Mae's? What's the catch?
Well, the catch is twofold. First, because there is no credit risk. The yield is significantly lower than corporate debt. You pay for that safety by accepting lower returns.
Right, and the second catch.
Second, while you eliminate credit risk, GNMA bonds are mortgage-backed securities, which means you are taking on massive reinvestment risk, specifically prepayment risk, which we will completely tear into later.
So you solve one problem by inviting another.
Exactly.
Let's test the listener on a highly specific credit risk scenario. This is a classic comparison that shows up on exams to see if you understand the underlying legal structures of products.
Oh, this is a good one.
Think about exchange-traded notes, ETNs, versus exchange-traded funds, ETFs. Which one of those carries the credit risk of the issuing financial institution? Take a pause.
The answer is the ATN, the exchange-traded note.
And understanding the why is critical here.
Yeah, an ETN is not a portfolio of stocks. It is an unsecured debt obligation of the issuing bank. It's basically a complex IOU where the bank promises to pay you a return based on the performance of a specific index.
Unsecured being the absolute key word there. There is no collateral.
None.
So if you hold an ETN issued by, say, Lehman Brothers in 2008, and Lehman Brothers goes bankrupt,
your ETN evaporates. You are just another unsecured creditor standing in that miserable buffet line we talked about.
You are completely exposed to the bank's credit risk.
But an ETF, an exchange-traded fund, is structurally entirely different. When a massive firm sponsors an ETF, the actual underlying assets, like the physical stocks or bonds, are held inside a legally separate trust.
So they are bankruptcy remote.
Exactly. Meaning if the sponsor firm goes belly up, the creditors can't touch the assets inside the ETF trust. The trust just gets transferred to a new manager.
So the ETF investor does not hold the credit risk of the sponsoring firm. Burn that distinction into your memory.
And before we leave credit risk, we absolutely must discuss its most insidious variant, downgrade risk.
Oh, man. Downgrade risk.
Yeah, this is the phenomenon where an issuer doesn't actually have to default for you to suffer massive financial damage.
Really? How does that mechanically happen? If the company is still making its interest payments on time, how am I losing money?
Okay, let's say Risky Rachel buys a corporate bond rated BBB. It's sitting right on the bottom edge of the investment grade threshold.
Right on the line.
Yeah. 6 months later, the company has a catastrophic earnings report. The rating agencies review the balance sheet and decide to downgrade the bond from BBB to BB.
So it crosses the threshold and officially becomes a junk bond.
Exactly.
Okay, but the company hasn't missed a payment yet. They've just been downgraded. What happens to the bond price?
It completely collapses in the secondary market immediately.
Wow, why?
Here is the mechanical reason why. Institutional mandates. Many massive pension funds and mutual funds have strict legal bylaws that prohibit them from holding junk bonds.
Oh.
The moment that rating agency drops the grade to BB, the algorithms and portfolio managers at these massive institutions are legally forced to automatically sell those bonds, regardless of the price.
So you have a massive flood of forced selling hitting the market all at once. And simultaneously, any potential new buyer sees the downgrade and demands a much higher yield to take on the newly recognized risk.
Right. And the only way an existing fixed-rate bond can offer a higher yield to a new buyer is if the price drops drastically.
So even though the company hasn't defaulted, Rachel's bond just lost 20% of its market value overnight.
Precisely. The market price is in the probability of default long before the actual default occurs.
Man, the market is utterly ruthless. Okay, let's organically transition here. We just established that credit risk is the fear of not getting paid.
Right.
But what if the borrower is fantastic? What if they pay you perfectly on time in full for decades? But when you finally take that cash to the store, it's completely worthless.
You are talking about inflation risk, also known as purchasing power risk.
Yeah.
And it is arguably the most destructive force in finance because it operates in total silence.
It really does. You look at your brokerage statement, the nominal numbers are staying flat or even going up, and your brain releases dopamine.
You feel totally safe. But your actual tangible wealth is vaporizing.
Let's bring in Forgetful Fred to illustrate the mathematical devastation of inflation.
Perfect.
Let's say it's the year 2004. Fred wants safe, guaranteed, predictable income. So he buys a 30-year corporate bond that pays him a fixed $50 every single year.
Okay.
He takes the bond certificate, buries it in his backyard, and falls asleep for 20 years. He wakes up today, digs it up, and cashes his $50 check. He is thrilled. $50 is $50, he says.
Right, he walks down to the grocery store.
But the macroeconomic environment has completely shifted around him. In 2004, that $50 could buy a week's worth of groceries.
Easily. Today, after 2 decades of compounding inflation, a gallon of milk is $5, a dozen eggs is $6, and that $50 barely buys him 2 bags of basic supplies.
The physical dollars are exactly the same, but the purchasing power of those dollars has been severely diluted.
Let's put the math to this, because the exam requires you to understand the difference between a nominal return and a real return.
Good call. The nominal return is just the raw percentage written on the piece of paper, right? If Fred's bond pays a 4% coupon, his nominal return is 4%.
But to find the real return, you must subtract the current inflation rate from the nominal return.
So if Fred is earning 4% on his bond, but the overall economy is experiencing 6% annual inflation.
So Fred's real return is negative 2%.
Wow.
He is not treading water. He is actively drowning, losing 2% of his wealth's buying power every single year he holds that asset.
So if we look across the entire landscape of asset classes, who gets slaughtered by inflation and who acts as a shield?
The absolute biggest victims of inflation risk are cash and long-term fixed-rate bonds.
Cash is obvious. I mean, it generates essentially zero yield while the cost of goods rises around it.
But long-term fixed bonds are uniquely vulnerable because you have locked your money into a static payment for decades, completely removing your ability to adapt to a rising cost of living.
And the shields, what protects you?
Equities, meaning stocks and real estate, are historically fantastic hedges against long-term inflation.
Okay, why?
Think about the underlying mechanics of a publicly traded company. If the cost of raw materials and labor goes up due to inflation, what does a strong company do?
They pass those costs on to the consumer by raising the prices of their products.
Exactly. Their top-line revenue expands, their earnings nominally increase, and their stock price generally rises to match the inflationary environment. They have pricing power.
And real estate works similarly, right? Property values and rental rates tend to naturally inflate alongside the broader economy.
Precisely.
But wait, let's go back to cautious Carl. Carl refuses to buy stocks or real estate because he hates capital volatility.
Right. He only wants U.S. government debt.
But he also doesn't want to get destroyed by inflation like Fred. What is the specific financial instrument designed just for him?
He needs to buy TIPS, Treasury inflation-protected securities.
Oh, these are brilliant, highly tested instruments. Because they are issued by the U.S. Treasury, they have essentially zero credit risk.
Right, but they have a unique mechanical feature that completely neutralizes inflation risk.
Break down the plumbing of TIPS for me. How do they actually adjust?
The principal value of a TIPS bond is not static. It automatically adjusts semi-annually based on the official consumer price index, the CPI.
Okay.
If the CPI shows that inflation is rising, the U.S. Treasury literally increases the principal value of your bond.
So because your fixed interest rate is calculated based on that higher principal, your semi-annual cash coupon payments increase as well.
Exactly. So if you have a $1,000 TIPS bond paying 2% and massive inflation hits, the principal adjusts to, say, $1,100.
Your 2% is now calculated on $1,100, meaning you get a bigger check.
Exactly. However, we should flag a critical advanced concept here regarding TIPS, sometimes known as the phantom tax.
Ah, this is a tricky one.
Even though you don't receive that increased principal until the bond matures or you sell it, the IRS taxes that upward principal adjustment in the year it occurs.
So you are paying tax on phantom income you haven't physically touched yet.
Yep.
That is a phenomenal detail. Okay. Pattern interrupt time. Shake off the domestic U.S. economy for a second. We are leaving the country.
Let's go.
Risky.
Mm-hmm.
Rachel is bored with the S&P 500, and she decides she wants to aggressively invest in European equities.
Okay.
The moment she crosses the border, she triggers an entirely new vulnerability. Currency risk, or exchange rate risk?
Currency risk is the danger that fluctuations in foreign exchange markets will erode the value of your investment when it is converted back into your home currency.
And for the sake of the exam, we are always viewing this from the perspective of a U.S. investor converting foreign gains back into U.S. dollars.
This trips up so many candidates because it requires thinking in two layers simultaneously: the performance of the asset and the performance of the currency.
Let's run a thought experiment. Rachel buys a French technology stock using euros. Over the next 12 months, the company completely crushes its earnings. The stock price goes up 10% in the European markets. Rachel looks at the chart and says, "I'm a genius. I made 10%.
But she isn't accounting for the macroeconomic currency shift. During that same 12-month period, the euro significantly weakened against the US dollar.
Let's say the euro dropped 8% in value relative to the dollar.
So what happens mechanically when she hits the sell button?
She sells the stock and collects her principal plus her 10% gain entirely in euros.
But Rachel's landlord in New York doesn't accept euros.
Right, she has to convert that pile of euros back into US dollars.
And because the euro is now worth 8% less than when she started, the exchange rate completely cannibalizes her investment returns.
So when the math settles, her actual return in US dollars is only around 2%.
The currency fluctuation vaporized the vast majority of her brilliant stock-picking gains.
This leads to one of the most counterintuitive concepts on the entire SIE exam. Here is where a lot of test takers lose points because they let patriotism cloud their math.
Very true.
If you are a U.S. investor holding foreign assets, is a strong U.S. dollar a good thing or a bad thing? Pause for a second. Think about it.
A strong U.S. dollar is devastatingly bad for U.S. investors holding foreign assets.
It sounds so wrong. USA, strong dollar, number one.
But let's look at the mechanics.
All right.
If the dollar is strong, it means foreign currencies are weak by comparison.
So when your foreign investment, which is denominated in that weak foreign currency, is converted back into your massive, strong U.S. dollars,
It buys fewer of them.
conversely, a weak U.S. dollar is fantastic for foreign investments.
If the dollar weakens, foreign currencies become relatively stronger, meaning they translate into a greater number of U.S. dollars when you bring the money home.
Let me play devil's advocate again. What if cautious Carl wants exposure to a massive Japanese company like Toyota, but he is terrified of dealing with foreign exchanges? So he buys an ADR, an American depository receipt. It trades on the New York Stock Exchange. It is priced in U.S. dollars. He buys it with U.S. dollars. He thinks he has completely bypassed currency risk. Is he right?
He is completely wrong. ADRs absolutely carry currency risk.
Why?
An ADR is just a receipt issued by a U.S. bank representing shares of a foreign stock held overseas. Toyota is still doing business in Japan. They're generating revenue in yen, and they declare their dividends in yen.
So the underlying mechanics still rely on the foreign currency.
Precisely. When Toyota pays a dividend in yen, the U.S. bank holding the underlying shares receives those yen, converts them into U.S. dollars at the current exchange rate, and then passes the dollars to Carl.
So if the yen has plummeted in value against the dollar, Carl's dividend payment is going to shrink drastically.
The currency risk is baked directly into the plumbing of the ADR.
Absolutely brilliant. Okay, we have survived the silent wealth killers of inflation and currency. Let's transition to what I like to call the seesaw of doom.
The seesaw of doom. I like that.
We just talked about how inflation eats away at fixed payments. Naturally, the central banks, like the Federal Reserve, fight inflation by raising interest rates.
Right.
But when they do that, they trigger an entirely new violent nightmare for bondholders: interest rate risk.
If there is one single mechanical relationship you must memorize for this exam, it is the inverse relationship between interest rates and bond prices. It is a fundamental law of physics in the financial markets.
When interest rates go up, existing bond prices go down. When interest rates go down, existing bond prices go up.
Imagine a playground seesaw. Rates on one side, prices on the other.
But why? Let's not just state the rule. Let's explain the plumbing. Why does the price of a perfectly good bond drop just because the Fed changed the target rate?
It comes down to yield and competition. Let's use a tangible analogy. Let's say you own a bond that pays a fixed 3% interest rate. You bought it 2 years ago.
It's a great corporate bond, no credit risk, perfectly fine.
But suddenly, inflation spikes, and the Federal Reserve aggressively raises interest rates. Because the baseline rate has moved, new corporate bonds being issued today are offering a 5% interest rate.
Okay, so I'm holding a 3% bond, and the guy next to me is holding a brand new 5% bond.
Right. Now imagine you need cash, and you want to sell your 3% bond on the secondary market. You approach another investor.
Why on earth would that investor pay full price for my bond yielding 3% when they could just call their broker and buy a brand new bond yielding 5%?
Exactly. Your 3% bond is like an outdated smartphone. It's functionally inferior to the new models on the market.
So the only way I can convince that investor to buy my inferior bond is to put it on clearance. I have to slash my asking price. I have to discount the bond so heavily that the combination of the lower price they pay plus my 3% coupon mathematically equals the 5% return they could get elsewhere.
This concept is called yield to maturity. Rising rates mechanically force the market value of all existing lower-yielding debt downward. That is interest rate risk in action.
Now, here is where we separate the amateurs from the experts. Who gets hurt the most when rates rise? Not all bonds react exactly the same way to that seesaw.
Right. To figure out who suffers the worst damage, we have to look at a metric called duration.
Duration is the mathematical measurement of a bond's price sensitivity to changes in interest rates. You can think of it as a multiplier.
If interest rates move by 1%, duration tells you exactly how violently the price of the bond will swing in the opposite direction. The higher the duration, the more volatile the bond.
So what structural features make a bond hypersensitive? What gives it a high duration?
Two primary features: a longer time to maturity and a lower coupon rate.
Think about forgetful Fred again. If Fred is holding a 30-year bond paying a microscopic 2% coupon, he is standing at the extreme edge of the seesaw.
He has locked his money up for a massive amount of time with very little cash flow coming in to offset his risk.
So if interest rates spike to 6%, his 30-year bond is going to get absolutely decimated in price.
Now compare that to a 2-year bond paying 5%. If rates spike, the 2-year bond's price will drop, but not by nearly as much.
Why?
Because the investor only has to wait 24 months to get their full principal back from the issuer and reinvest it at the new, higher 6% rate.
So the shorter the maturity and the higher the cash flow, the lower the duration.
And we should briefly mention convexity, which is the second-order derivative of this concept. Duration assumes a linear relationship, but bond price changes are actually slightly curved.
Right. Positive convexity means that as rates fall, bond prices rise faster than duration predicts, and as rates rise, prices fall slower.
But for the SIE, just focusing on the baseline rules of duration is usually sufficient.
Okay, let's spring the trap. Put yourself in the test maker's mind. They want to know what specific type of bond has the absolute highest interest rate risk in existence, the maximum possible duration.
This is a classic question. The answer is long-term, zero-coupon bonds.
Let's dissect why this is so counterintuitive. Because logically, a student might think, well, a zero-coupon bond doesn't pay any periodic interest payments. It's a simpler structure. Less moving parts must mean less risk, right?
That logic is completely backward. Because it has no cash flows, there's absolutely nothing buffering the price volatility.
All of your return is generated by the deep discount you received when you initially bought it, and you don't realize a single cent of that return until the final maturity date.
Therefore, mathematically, a zero-coupon bond's duration is exactly equal to its maturity. A 30-year zero-coupon bond has a duration of exactly 30.
It is the most hypersensitive, volatile fixed-income instrument you can possibly own. If rates tick up even a fraction of a percent, a long-term zero-coupon bond will plummet violently in value.
So interest rate risk is the terror of the seesaw going one way. Rates go up, you lose market value.
But what happens when the seesaw swings the other way? What happens when the Fed decides the economy is slowing down and they aggressively cut interest rates?
Well, according to the inverse relationship, existing bond prices go up. Your portfolio value skyrockets.
We're rich. Wait, this is finance. There is always a catch. What is the catch?
The catch is the mirror image nightmare. Reinvestment risk.
Let's unpack the mechanics of reinvestment risk. It is exactly what it sounds like. You own a bond. You are receiving your semi-annual cash coupon payments, or your bond reaches maturity, and you get a massive lump sum of principal returned to you.
That's great, but now you have a pile of cash sitting in your account, and you have to put it back to work.
And if the central bank has slashed interest rates in the meantime, you are forced to reinvest that cash into a new market offering terrible, much lower yields.
Let's do a quick interactive thought experiment for the listener to connect these concepts.
Let's do it.
We just established definitively that long-term zero-coupon bonds have the absolute highest interest rate risk in the world. So knowing that these risks operate as opposites, what is the reinvestment risk of a zero-coupon bond? Take a second. Think about the cash flow.
Sate. The answer is zero. A zero coupon bond has absolutely zero reinvestment risk.
Exactly. Why? Because there are no periodic coupon payments being sent to you during the life of the bond.
You cannot be forced to reinvest cash at lower market rates if the issuer isn't sending you any cash in the first place.
Your rate of return is entirely locked in from the moment of purchase until the moment of maturity.
That contrast is guaranteed to show up on the test. Maximum interest rate risk equals zero reinvestment risk. Okay, so if zero coupons have none, who has the highest reinvestment risk?
The bonds throwing off the most cash. High coupon bonds expose you constantly to the current market rates. But the ultimate trap, the absolute highest reinvestment risk, belongs to callable bonds.
Callable bonds are a reinvestment nightmare. Let's explain the plumbing here. When you buy a callable bond, you are granting the corporate issuer a special right.
You are giving them the right to call the bond back from you before maturity. They force you to take your principal back early, and they permanently stop paying you interest.
Now, put yourself in the shoes of the corporate chief financial officer. When are you going to exercise that right?
You are only going to call the bond when market interest rates drop significantly.
It is the exact same mechanical logic as refinancing a home mortgage.
Yeah.
If a corporation issued a bond paying you 8% a few years ago, and suddenly the Fed drops market rates to 4%.
The CFO is going to look at their balance sheet and say, why are we paying this guy 8%? Let's exercise the call feature, give him his principal back, and issue brand new corporate debt at the much cheaper 4% rate.
So you, the investor, suddenly get a massive pile of cash dumped into your lap exactly at the moment when the market is only offering a 4% yield.
You lose your lucrative 8% income stream, and you are forced to reinvest at half the rate.
This is why callable bonds offer slightly higher initial yields than non-callable bonds. You are being compensated for taking on that massive reinvestment risk,
which provides a seamless transition into a very specific, highly tested subset of reinvestment risk. This applies uniquely to mortgage-backed securities, or MBS. Let's talk about the prepayment versus extension risk dynamic.
The MBS special. Mortgage-backed securities are essentially massive pools of individual home mortgages bundled together.
As a homeowner makes their monthly mortgage payment, that cash flows through the pool to the investors. But homeowner behavior is entirely driven by interest rates.
Let's use an analogy to make this intuitive. Imagine lending your buddy $1,000 to buy a used car. You agree he's going to pay you an 8% interest rate over the next 5 years.
You are thrilled. 8% is a fantastic guaranteed return.
But a year later, the central bank slashes rates, and the local credit union is offering auto loans at 4%. Your buddy is smart. He goes to the credit union, gets a cheap 4% loan, takes that cash, walks into your living room, and hands you your $1,000 back early. He prepays you.
And how do you feel? You are furious because you just lost your 8% income stream.
You have your $1,000 back, but if you want to lend it out again to someone else, the going rate in the market is only 4%.
This is exactly what happens in the MBS market. This is prepayment risk. When interest rates fall, millions of homeowners rush to refinance their mortgages.
They take out cheap new loans to pay off their expensive old loans early.
The investors holding the mortgage-backed securities suddenly get a massive flood of their principal returned much faster than expected, and they are forced to reinvest it all at the new lower rates.
So rates fall equals prepayment risk.
Well, we must look at the flip side. What happens when the macroeconomic environment reverses?
Let's go back to your buddy. You loan him the $1,000 at 8%. But a year later, inflation skyrockets and the Federal Reserve aggressively hikes rates. Now, the credit union is charging 15% for an auto loan.
Your buddy looks at the 8% deal he locked in with you, and he realizes it is the deal of a lifetime. He is never going to pay you back a single day early.
He is going to drag out those payments for the absolute maximum legal duration of the contract because he is holding cheap debt in a high-interest world.
And you, the investor, are trapped. You are stuck holding investment paying only 8%, while the rest of the world is earning 15%. This is extension risk.
When interest rates rise across the broader economy, mortgage refinancing grinds to an absolute halt.
Nobody in their right mind trades a 3% fixed mortgage for an 8% mortgage, so prepayments slow to a crawl.
The average life of the mortgage-backed security extends far beyond what you originally modeled, locking your capital up at a below-market rate for years.
Here is how you memorize it for the exam.
Yeah.
They are two sides of the same miserable coin. Rates fall equals prepayment risk. The money comes back too fast. Rates rise equals extension risk. The money comes back too slowly.
Neither outcome is good for the investor. You are completely at the mercy of homeowner refinancing behavior.
Okay, let's pull back and change our perspective entirely. We have been deep in the weeds of specific asset mechanics, bonds, currencies, mortgage pools. Let's look at the broader architecture of the financial system.
Let's compare the macroeconomic picture to the microeconomic picture. Systematic versus non-systematic risk.
Let's start big. Systematic risk, which is frequently referred to on the exam as market risk. This is the big picture.
Systematic risk is the risk that the entire financial system, the global economy, experiences a massive shock that drags down almost every single security, regardless of how strong the individual companies are.
We are talking about massive, uncontrollable macroeconomic events. A sudden global recession, a world war breaking out, a global pandemic shutting down supply chains, a massive systemic failure of the banking sector like we saw in 2008.
These events do not care if a specific company has a flawless balance sheet and incredible leadership. When the macroeconomic tide goes out, all the boats drop simultaneously.
Exactly. And the financial industry actually has a specific mathematical metric to measure how much an individual asset gets pushed around by these massive market tides. It was called beta.
Beta measures a security's historical volatility relative to the overall market. The baseline is the broader market, usually represented by the S&P 500 index, which is assigned a beta of exactly 1.0.
So if Cautious Carl buys an ETF that tracks the S&P 500, his investment has a beta of 1.0. It perfectly mimics the market. If the broader market drops 10%, Carl's portfolio drops 10%.
But what if Risky Rachel buys a hyper-aggressive, speculative biotechnology stock with a beta of 2.0?
A beta of 2.0 means the asset is historically twice as volatile as the broader market. It amplifies the systematic swings.
If the S&P 500 drops 10%, Rachel's biotech stock is statistically likely to plunge 20%. Conversely, if the market goes up 10%, her stock could surge 20%.
And Cautious Carl might try to hide by buying a massive stable utility company with a beta of 0.5. It's only half as volatile. The market drops 10%, his utility stock only drops 5%. It smooths the ride.
But here is the ultimate question. Let me play devil's advocate. Let's say I recognize how dangerous systematic risk is. So I decide to build the ultimate bunker.
Oh.
I buy 2,000 completely different stocks. I buy technology, healthcare, agriculture, gold miners, energy companies, everything across the globe.
Yeah.
By spreading my money out that vastly, am I finally safe from systematic risk?
Absolutely not. This is a foundational law of modern portfolio theory. You cannot diversify away systematic risk.
It is mathematically impossible.
If a global pandemic shuts down the entire world economy, the agricultural stocks drop, the tech stocks drop, the energy stocks drop, all 2,000 of your companies will suffer. Diversification is a completely useless tool against true systematic market risk.
Do not forget that rule. It is heavily tested. So if we cannot diversify away systematic risk, what exactly can we diversify?
That brings us to the micro level. Non-systematic risk, also known as unsystematic risk or business risk.
This is company-specific risk. This is the risk that one particular company trips on its own shoelaces, completely independent of the broader economy.
Imagine a massive pharmaceutical company. The overall economy is booming, but this specific company's highly anticipated new cancer drug catastrophically fails its phase 3 clinical trials.
Or their CEO is suddenly indicted for embezzlement, or their primary manufacturing plant burns to the ground.
Those are horrific events for that specific corporation. Their stock price will plummet. But those events have absolutely zero impact on the broader stock market.
Apple, Microsoft, and Tesla do not care if a random pharmaceutical plant caught on fire. The S&P 500 will continue marching upward.
This is the risk you can fix. And the specific mechanical fix is diversification.
But how much diversification do you actually need? Do you need to own 500 stocks to be safe?
Actually, the math behind modern portfolio theory shows that you hit a point of diminishing returns very quickly. Holding just 25 to 30 well-diversified stocks across various uncorrelated sectors of the economy virtually eliminates non-systematic risk.
So if you own 30 distinct companies and one of your CEOs gets fired for a scandal, that stock might drop 50%. But because it's only a tiny fraction of your portfolio, it barely makes a dent in your overall net worth.
Which leads directly to a classic textbook SIE exam scenario. Listen closely to this phrasing. The test will present this exact setup. An investor holds a fully diversified portfolio of 50 blue-chip stocks spanning multiple global sectors. What type of risk remains in this investor's portfolio?
And the answer is always invariably systematic risk. or market risk.
Because the investor has successfully assassinated the non-systematic risk through their diversification, but the systematic market risk remains completely invincible to that strategy.
Let's add a slightly more nuanced layer to the macroeconomic picture. Political risk, sometimes referred to as sovereign risk in specific contexts.
This sits at a weird intersection of finance and government policy. It is the risk that sudden government actions, legislative instability, or massive political shifts will negatively alter the regulatory environment and crush your investment returns.
When most candidates hear political risk, their minds immediately jump to international investments or emerging markets.
They envision a violent revolution in a developing nation, or a sudden military coup where a new dictator nationalizes all the privately owned oil fields and seizes foreign assets.
And to be fair, that is a massive source of political risk. If you own emerging market mutual funds or certain American depository receipts, you are highly exposed to that exact geopolitical volatility.
However, here's where candidates lose points on the exam. They assume political risk only happens overseas, but the test might give you a purely domestic scenario.
Let's say the U.S. Congress unexpectedly passes a massive, highly restrictive new regulatory framework on domestic healthcare providers, capping their profit margins. Or the EPA imposes a draconian new tax on domestic coal producers.
That sudden government legislation actively destroys the future earnings potential of those specific U.S. companies. Their stock prices will plummet. That is still classified as political risk.
Do not fall into the mental trap of assuming political risk only involves foreign dictators. A stroke of a pen in Washington, D.C. carries massive political risk for domestic portfolios.
Let's tackle one final critical risk profile before we move to the solutions. Liquidity risk.
I call this the roach motel risk. Your money checks in, but it cannot easily check out.
Liquidity risk is the danger of being entirely unable to sell an investment quickly, or being forced to accept a massive punitive discount on the price just to liquidate the asset.
To understand this, you have to view liquidity not as a binary state, but as a spectrum.
On the highly liquid, frictionless end of the spectrum, you have large cap publicly traded stocks, U.S. Treasuries, and exchange-traded funds.
You can log into your brokerage app, click sell, and the transaction executes in milliseconds at the exact publicly quoted market price.
Let's pause right there and explain the plumbing of mutual funds, because they sit in a unique spot on that spectrum.
Open and mutual funds are highly liquid, but they operate mechanically differently than an ETF. If you want to sell an open-end mutual fund, you do not go to a stock exchange and find another investor to buy your shares.
Correct. You redeem your shares directly back to the mutual fund company itself, and they are legally obligated to cash you out based on the net asset value, the NAV.
But that NAV is only calculated once a day at the close of the market. You don't have intraday liquidity like an ETF. But you do have guaranteed daily liquidity. You will get your cash.
But let's look at the dark end of the spectrum, the illiquid end. This is where alternative investments live.
Things like direct participation programs, or DPPs, private hedge funds, and non-traded real estate investment trusts, or REITs. These structures are incredibly difficult to exit.
Imagine cautious Carl gets talked into buying a massive position in a private real estate limited partnership, a DPP. A month later, he has a medical emergency and desperately needs that cash.
He cannot just log into an app and click sell. There is no centralized stock exchange for private partnerships.
He has to go out into the secondary market and physically find another human being with enough capital who is willing to take over his highly specific partnership units.
And when he finally finds a potential buyer, that buyer knows Carl is desperate for liquidity. The buyer holds all the leverage.
So the buyer says, the paper value of your share is $100,000, but because this is so hard to value and trade, I will only take it off your hands for $60,000.
That massive $40,000 haircut Carl is forced to take simply to access his own capital is the physical manifestation of liquidity risk.
So the key takeaway for the exam, if a question asks you to identify the asset with the highest liquidity risk, immediately scan the multiple choice options for the alternative investment, a DPP, a hedge fund, a non-traded REIT, or restricted unregistered stock.
Okay, take a deep breath. We have spent the last 45 minutes absolutely terrifying the listener.
We really have. We've talked about bankruptcies destroying principal, rating agency downgrades, silent inflation, violent interest rate seesaws, trapped mortgages, global market crashes, and illiquid roach motels.
It is time to talk about the armor. Section 5. The fixes. How do professional investors actually mitigate these threats?
We already touched on the first line of defense, diversification. But we need to explain how true diversification mathematically works, because it is not just about hoarding a high quantity of assets.
Right. Buying 100 stocks does not make you diversified if they all react identically to the same macroeconomic stimuli. True diversification is built on a mathematical concept called correlation.
Correlation measures how two distinct investments move in relation to one another. The scale runs from positive 1.0 to negative 1.0.
If Risky Rachel buys 50 different technology stocks, software developers, semiconductor manufacturers, and cloud computing firms, does she have a diversified portfolio?
She absolutely does not. All of those companies operate in the same sector. They have a highly positive correlation, likely close to plus 0.8 or plus 0.9.
That means if the tech sector experiences a massive downturn, all 50 of her stocks are going to crash in lockstep at the exact same time. She has volume, but she does not have diversification.
To build true armor, you want to combine asset classes that have a correlation of 0, meaning their price movements are completely independent of each other, or ideally a negative correlation.
Perfect negative correlation is a score of exactly negative 1.0. That means they move in mathematically opposite directions. If asset A goes up 10%, asset B goes down 10%.
By blending uncorrelated assets, stocks, bonds, real estate commodities, you smooth out the violent peaks and valleys of the portfolio's overall performance.
But here is the problem. Diversification only sets your initial risk parameters. The moment you implement the portfolio, the chaotic nature of the financial markets begins to warp it.
Which brings us to the second necessary fix: portfolio rebalancing.
Rebalancing is the mechanics of maintaining your target. Let's look at cautious Carl. Carl sits down with a financial advisor and they rigorously determine that his exact mathematical risk tolerance requires a portfolio of 60% broad market stocks and 40% government bonds, a classic conservative 60-40 split. He sleeps peacefully.
But then the economy enters a massive, multi-year technological boom, a raging bull market. Carl's stock holdings triple in value over 5 years, while his government bonds just slowly drip tiny amounts of interest.
If Carl is forgetful Fred and he just ignores his account, what happens? After 5 years, because the stocks grew exponentially faster than the bonds, his portfolio is mathematically warped.
It is no longer a 60-40 split. Stocks now represent 80% of his total net worth, and bonds have shrunk to 20%.
He has experienced massive allocation drift. Without making a single conscious trade, Carl is suddenly taking on Risky Rachel levels of equity exposure.
If the stock market experiences a sudden 30% crash tomorrow, Carl is going to suffer catastrophic financial damage that his nervous system is completely unequipped to handle because he is radically overexposed to the most volatile asset class.
So what is the mechanical fix? Portfolio rebalancing. Carl must actively restore his portfolio to the original 60-40 target. How does he do that?
He has to execute trades. He has to sell off a massive chunk of his overweight asset, the stocks, and use that resulting cash to buy more of the underweight asset, the bonds.
And this reveals a brilliant embedded mechanism that the test makers love to ask about. Rebalancing strips human emotion out of investing.
Yes. By forcing Carl to sell his stocks precisely when they are at all-time highs and forcing him to buy bonds precisely when they are lagging, rebalancing enforces a strict, mechanical buy low, sell high discipline.
Human psychology wants to chase the winners and abandon the losers. Rebalancing mathematically forces you to trim your recent winners to buy more of your recent losers. It is a brilliant systemic control.
However, we must be intellectually honest. Rebalancing is a maintenance strategy. It controls risk drift. But if the entire global market is crashing, rebalancing isn't going to save you from taking a loss.
If you want actual heavy-duty mathematical armor against a systematic market crash, you have to utilize the third fix: hedging.
Hedging. Using complex financial instruments, specifically options contracts, to mathematically offset potential losses in your primary portfolio.
We established earlier that you cannot diversify away systematic market risk, but you absolutely can hedge it. Let's do a deep dive side-by-side comparison of the two most frequently tested hedging strategies: the protective put versus the covered call.
Let's start with the protective put. The mechanics are exactly what the name implies. You own 100 shares of a stock and you are terrified that a recession is about to wipe out its value.
So you go into the options derivatives market and you buy a put option contract.
A put option gives you the legal right to sell your 100 shares at a specific guaranteed price called the strike price before a specific expiration date, regardless of how low the actual market price falls.
Think of a protective put exactly like buying comprehensive insurance on a brand new car. When you buy car insurance, you pay a premium upfront. It costs you cash out of pocket.
But if you drive the car off the lot and instantly wrap it around a telephone pole, meaning the stock crashes to absolute zero, the insurance contract kicks in.
You can force the option writer to buy your worthless stock at the high strike price. It mathematically caps your maximum possible downside loss. You can sleep peacefully during a recession.
And what is the mechanical beauty of this strategy if the market goes up?
That's the best part. If the stock doesn't crash, and instead it rockets to the moon, you still own the stock. Your upside profit potential is completely unlimited.
The only drag on your massive gains is the small initial premium you paid for the insurance contract, which just expires worthless.
Now, let's contrast that protective armor with a covered call. A covered call is structurally entirely different. You own the 100 shares of stock, but instead of buying an insurance policy, you sell a call option contract to another trader in the market.
You are legally granting someone else the right to buy your stock away from you at a set strike price.
Because you are taking on an obligation, you get paid. You collect a cash premium upfront. You are generating immediate income.
Think of a covered call like renting out your car on the weekends while you aren't using it. You get handed cash just for letting someone else have access to your asset.
That cash premium you collect does provide a tiny, tiny mathematical cushion if the stock price drops slightly. But here is the massive structural vulnerability. What happens if the stock price goes to the moon?
You don't get to participate in the party. If the stock explodes upward, the trader you sold the call option to is going to exercise their legal right.
They are going to rip the stock out of your account at the lower agreed upon strike price. You completely cap your upside potential. You traded away your massive future gains for a tiny upfront cash payment.
Which leads to a massive, frequently tested exam distinction. Candidates routinely confuse these two. Covered calls do not offer true downside protection.
If your stock drops 50% in a massive market crash, that tiny little premium you collected from selling the call is not going to save your portfolio. Only a protective put provides true, mathematically defined downside protection against systematic risk.
Exactly. Protective means buying a put. The test makers literally put the word in the name to help you.
If the exam question asks which strategy provides maximum downside protection, hunt for the put option. If it asks which strategy generates partial income in a flat market, look for the covered call.
We have covered a truly massive amount of ground today. We have traced the mechanics of risk from the basic definitions of capital loss all the way through the complex plumbing of duration, MBS extension, and options hedging.
Which means it is time to synthesize everything. It is time for the rapid-fire recap. I'm going to throw the core concepts out, and I want you, the listener, to try and beat the expert to the punchline. Visualize the plumbing. Ready? Let's go. U.S. Treasuries, are they completely risk-free?
No, they have zero credit risk, but they carry massive inflation risk and interest rate risk, and capital risk if sold before maturity.
The seesaw of doom. The Federal Reserve raises interest rates. What happens mechanically?
Existing bond prices go down. It is a strict inverse relationship.
You are looking at a list of bonds. Which specific structure has the absolute maximum interest rate risk, the highest duration?
Long-term, zero-coupon bonds. No cash flow means hypersensitivity to rate changes.
Let's reverse the seesaw. Rates drop drastically. Which bonds expose you to the maximum reinvestment risk?
Callable bonds and high-coupon bonds. The issuer will refinance and force you to accept lower market yields. And remember, zero-coupon bonds have zero reinvestment risk.
A global pandemic shuts down the entire world economy. What kind of risk is this, and can you diversify it away?
Systematic market risk. And no, you absolutely cannot diversify it away. You can only hedge it with options.
Last one. Inflation is running hot at 8%. What asset class is enemy number one? Who suffers the most silent destruction?
Long-term, fixed-rate bonds and cash. Their purchasing power gets mathematically vaporized.
Beautiful. If you can understand the why behind those rapid-fire answers, you are not just going to pass this section of the SIE. You are going to truly understand how global capital moves. But before we sign off, we want to leave you with one final provocative thought to mull over, a little philosophical deep end. We established at the very beginning that risk and return are perfectly mathematically tethered. You cannot have one without accepting the other.
Right. But consider the mechanics of the protective put we just discussed. When you buy a put option to hedge your portfolio against a catastrophic market crash, You are actively taking cash out of your account and handing it to someone else as a premium.
You are mathematically guaranteeing yourself 100% certain realized financial loss, the cost of that premium, in order to prevent a hypothetical systemic loss that may never even happen.
Which raises an incredible question about human psychology and market structure. Does that mean the only true mathematical way to survive the violent swings of the financial markets over a 40-year investing timeline is to accept that you must voluntarily pay a permanent tax on your own peace of mind? Are we all ultimately just renting our sanity from the options market derivatives desk?
It's a fascinating paradox. The safest mathematical move is to guarantee yourself a small, continuous loss.
And that deep mechanical complexity is exactly why we love this stuff. As you keep studying, keep visualizing the characters. See cautious Carl sweating over a capital loss. Picture risky Rachel jumping off buildings, chasing junk bond yields. And imagine forgetful Fred waking up to find his money has been eaten by inflation.
Understand the plumbing, respect the traps, and you are going to completely crush this exam. Thanks for joining us on this deep dive. Keep grinding, and we will catch you next time.